Welcome to this explainer. Right now, we're living through what is arguably the biggest technological boom since the dawn of the internet. But, if you follow the financial markets, there's this distinct sense of panic in the air. The AI revolution is absolutely everywhere you look, right? It's embedded in our phones, it's totally transforming enterprise software, and it is dominating the daily news cycle. But despite this massive, world-changing momentum, the financial markets are displaying some severe turbulence. So today, we're investigating a fascinating paradox. We're looking at the case of the missing AI profits and unraveling exactly why an undeniable technological boom is causing so much economic anxiety.
Okay, let's dive right into this. It's the ultimate paradox for anyone watching the markets right now, and honestly, it's a contradiction that kind of seems to defy basic logic. If artificial intelligence is genuinely booming, and if these incredible new tools are being rapidly adopted by businesses and consumers globally, why on earth are tech stocks dropping? We are constantly bombarded with the limitless hype of AI, yet we're simultaneously slapped with the harsh reality of declining tech stock performance. It really feels like two completely different realities are trying to exist at the exact same time, the reality of Main Street adoption and the reality of a Wall Street sell-off. And hey, if you're feeling a bit confused by this massive disconnect, you are certainly not alone. Take a look at this real market sentiment from the institutional experts over at JP Morgan Asset Management Hong Kong. They asked, with tech stocks correcting, what's next for AI? This single, pressing question perfectly captures the anxiety surrounding the tech sector right now. It totally validates the confusion so many of us are feeling and establishes the incredibly high stakes of the volatility we're witnessing today. Literally everyone, from everyday retail traders to massive institutional funds, is trying to figure out what happens when the unstoppable force of AI hype meets the immovable object of strict market expectations.
Now, before we really get into the why behind this paradox, let's quickly bust some jargon and look at the mechanics of this current market correction. What we're seeing across the tech sector isn't just a slight, temporary dip. It's a sharp, notable pullback driven by one primary trigger, and that's growing investor anxiety. When the market gets nervous about the timeline and profitability of AI, investors don't just sit around waiting for the dust to settle. They sell, and prices tumble. This anxiety isn't about whether AI actually works. It's a growing fear about whether the astronomical cost of building it will actually pay off in a reasonable time frame. So who exactly is making these investors sweat so much? Let me introduce you to the prime suspects of our mystery, the hyperscalers. You already know the players: Alphabet, Microsoft, Amazon, Meta. But what matters right now isn't who they are, it's what they're doing. They are laying down the physical, concrete foundation of the AI revolution at a pace and scale we have literally never seen before in modern business. These 4 or 5 massive companies are essentially shouldering the financial weight of an entire technological paradigm shift, and their actions are dictating the rhythm of the entire broader market.
And when I say they are spending on this physical foundation, get ready for this. $725 billion. I'll just let that staggering figure sink in for a second. To put that into perspective, that is more than the entire gross domestic product of many developed nations. This represents the estimated capital expenditure by just these major tech companies, solely dedicated to building out AI infrastructure. We are talking about acquiring massive tracts of land, securing immense power grids, and buying millions of highly specialized, insanely expensive semiconductor chips. To wrap our heads around the sheer scale of these capital expenditures, or CapEx, think of it like a mega mansion analogy. Basically, what these tech giants are doing right now is taking out unprecedented loans to build the most sprawling, high-tech mega mansions the world has ever seen, well before they even have a single buyer lined up to move in. They're constructing the ultimate smart homes of the future, pouring endless concrete and wiring cutting-edge servers, entirely on the assumption that eventually the market demand will rise to meet this massive supply they're generating.
So why on earth would these highly calculated companies do that? Why spend hundreds of billions of dollars before the revenue is an absolute guarantee? Well, it comes down to scaling the infrastructure, which is totally driven by intense competitive paranoia. Tech executives are justifying these massive data center and advanced semiconductor purchases simply to maintain their competitive edge. In their eyes, whoever builds the fastest, largest, and most capable AI infrastructure just outright wins the future. They aren't just spending for today's profits, they are absolutely terrified of being left behind tomorrow. It's the ultimate fear of missing out, played out on a multi-billion-dollar stage.
But as you can imagine, an investment of that magnitude doesn't just happen in a vacuum. Capital is concentrating so heavily on this specific digital infrastructure that it's acting more like a financial black hole, just sucking in budgets from across the entire broader corporate landscape. CFOs are pausing everyday software upgrades, freezing traditional IT hiring, and slashing peripheral departments because that money is flowing like a river straight into the AI infrastructure build-out. Every available dollar is being redirected to ensure these companies have the computing power necessary to stay relevant in the AI arms race.
And this brilliantly illustrates the core conflict at the heart of our market mystery. On one side, we have this massive, heavy, long-term infrastructure spending that's going to take years to fully optimize. On the other side, we have the market's relentless demand for short-term revenue and immediate financial returns. It's a fundamental clash of timelines. These tech titans are building complex, world-changing infrastructure for a decade from now, while the market fully expects to see the profit margins on the very next quarterly earnings call.
And right now, Wall Street analysts are aggressively reviewing those quarterly reports, and they're using return on investment, or ROI, basically as a weapon. During recent earnings calls, the tone has noticeably shifted. Analysts aren't sitting around debating if AI is cool or innovative anymore. They are looking strictly at the math. They're heavily questioning the timing and the sheer scale of these massive corporate outlays, demanding to know exactly when this hundreds of billions of dollars in spending will actually yield proportional, undeniable financial gains.
So how exactly does this clash of timelines play out in real time? Well, it creates a pretty predictable vicious cycle. Step 1. This unprecedented spending on data centers and chips completely depletes short-term corporate cash reserves and often increases a company's reliance on debt. Step 2. Seeing those newly depleted cash reserves absolutely spikes investor anxiety, which immediately triggers sharp stock sell-offs. And finally, Step 3. As those stock prices drop, company valuations take a significant hit, suddenly forcing tech leaders onto the defensive. They find themselves scrambling on public calls to justify their massive spending strategies and constantly promising future profitability to some very unhappy, impatient shareholders.
So the crucial point here is that the fallout from this cycle isn't contained to just one or two companies. We are seeing widespread collateral damage across the global economy. As investors frantically sell off what they perceive as overvalued tech stocks, entire benchmarks suffer. When a major hyperscaler sneezes, the rest of the market catches a cold. We see massive indices like the Nasdaq take a significant hit, the semiconductor sector drops right alongside it, and ultimately, everyday shareholder value across countless retirement accounts and mutual funds is harmed by the resulting volatility.
All right, let's take a collective breath here and slow down for a second. Where do we actually go from here? If you're trying to intelligently navigate this landscape, you've got to look well beyond the initial hype of generative AI. The path forward demands that we transition into a show-me-the-money phase, evaluating these companies based on concrete, traditional financial metrics. We can't just get excited about a flashy new AI feature or a sleek product demo anymore. We have to ask the hard, practical questions about how exactly that feature translates to the bottom line before making any serious investment choices.
So what should you ultimately take away from all this? The reality check is simple. AI tools have to start proving they can create sustainable revenue streams rather than just endlessly driving up operating and energy costs. Companies can't rely on aggressively estimated future demand that might shift unexpectedly. They have to balance today's massive infrastructure costs with actual measurable profit margins. But above all else, please remember this. Short-term market corrections driven by impatient capital do not equal a technology's long-term failure. The foundation being built today is very real, even if the timeline to profit is a lot longer than Wall Street wants. Which, honestly, leaves us with a pretty provocative thought to ponder. Are Wall Street's short-term corrections and constant demands for immediate ROI blinding us to AI's genuine, long-term utility? Think about that tension between the incredibly impatient demands of modern financial markets and the inherently slow, world-shifting reality of an actual technological revolution. Are we so intensely focused on this quarter's missing profits that we are entirely missing the bigger picture of what's being built? Thank you so much for joining me for this explainer, and keep your eyes on those fundamentals.